All right, well, we're not going to wait for stragglers to come in. Good afternoon, everybody. I'm Dick Berner, and I'm delighted to welcome you today to our fireside chat, the first this semester. The host of today's fireside chat is the Stern Center at NYU for Global Economy and Business. The center serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. Our purpose today is to promote a rich dialogue among market participants, current and former policymakers, and the NYU community. The program today will last 75 minutes. I'll engage our distinguished guests in a dialogue in the first part, followed by audience Q&A that I will moderate, and we'll finish by 5:30. Please note on the screen that you can submit questions to the panel. I'm going to switch over the screen. If I can make it work. Okay. Please note on the screen that you can submit questions to the panel using your smartphone or other device by going to the website slido.com and entering the code number 6666 in the box labeled Join. Since we do not accept anonymous questions, please add your full name along with your question. You can also vote on the questions that others have submitted. This will help us judge the issues that are of greatest interest to you. Now, our distinguished guests may be known to many of you, but I want to spend a minute on their background. Barbara Novick, just to my left, is the vice chair and a co-founder of BlackRock, which manages $7 trillion in assets. I think I have that number right. She oversees the firm's efforts globally for public policy and for investment stewardship. In my previous job, Barbara was one of my most active, thoughtful, and constructive critics, something every public official should cherish. Sandy O'Connor, seated next to Barbara, is the Chief Regulatory Affairs Officer for JP Morgan Chase & Company. She articulates and directs the firm's global regulatory strategy. She also chairs the Alternative Reference Rates Committee, which is the U.S. private group convened by the Fed to help develop LIBOR alternatives. Sandy's leadership has been critical to that process. And Sandy is a member of the OFR's Financial Research Advisory Committee. Perhaps most important for this audience, Sandy received her BS here at the business school, where she was a university scholar. I can't think of two people better than Barbara and Sandy to offer their perspective on today's topic, the future of financial regulation. Please join me in welcoming them to Stern. Now, I want to start by framing some of the issues that we're going to talk about today. The financial crisis that began 11 years ago spawned major changes to the U.S. and global financial regulatory infrastructure. These changes focused appropriately on the safety and resilience of financial institutions, markets, and the financial system. Today, the financial system is safer and more resilient. So one question is, are we thus ready for the next financial crisis? We also need humility. Our regulatory structure remains imperfect, as are the changes we made over the past decade. So this afternoon, we want to explore the pros, cons, and future of financial regulation. One criticism is that the changes went too far, created unneeded burdens on industry. We should carefully evaluate the evidence for such claims. On the other hand, in some cases, perhaps regulation did not go far enough. We should carefully look at where gaps might persist. Some argue that any change to Dodd-Frank amounts to a rollback that would undermine resilience. There's no evidence, in my view, for that sweeping claim. Moving from a one-size-fits-all framework to one that correlates oversight with risk is not a rollback of Dodd-Frank. In fact, there's a more nuanced case that regulation should be balanced between resilience and effective, efficient, and appropriately tailored. And looking for that balance is an appropriate place to start our discussion this afternoon. So we're going to start using my prerogative as moderator with, so Barbara and Sandy, do we have that balance right? Where have we not gone far enough, leaving gaps or insufficient resilience? And where have we gone too far, created unneeded burdens on industry?
Okay, so we didn't rehearse this, so we're not sure who's going first, but we'll just
go down the line. It's all good.
The chat.
So I think the first thing is you have to sort of take stock of what was already done. And we look at the regulation as having 6 big categories. One is bank capital stress testing liquidity. I'll defer to Sandy. She knows more about that than I ever will.
I know a lot about that stuff.
Second is OTC derivatives rule, which affect everyone in the whole ecosystem. Third is improved cash investing rules, which we'll talk about as one of the unfinished pieces of business. It's been fixed for some, but not for all. Fourth is reporting. At the height of the crisis, they didn't even know who to call in the alternative space. They didn't have a directory, never mind know what individual firms were doing. They couldn't even tell you the names and phone numbers of people to get market color from on the hedge fund space. So having more reporting and registration there. Fifth is mutual fund rules and reporting. And we have been a tremendous advocate of what we call product and activities regulation, mutual fund reporting and liquidity rules being a perfect example of that. And then lastly is corporate governance rules. All of these categories fit together in a big puzzle, and I would say the system itself is safer today. Now, safer does not mean it's 100% foolproof, but there is, I think, a high degree of safety. If anything, I think people would argue the pendulum swung too far in the regulatory direction, and that doesn't mean throw it all out, rip it up, but I call it right sizing. And when this movement first started, it actually did not start in the U.S. It started in Europe. They had something they called the call for evidence. It didn't get anywhere near the amount of press and agita that it did here when the Treasury started writing reports and there was discussion of rolling things back in the U.S. So go figure. I'm not going to say it's fake news, but clearly there's a media component. And the FSB itself, who has been a standard setter, they have said we need to step back and look. So I think all of these entities, they're not looking to throw the baby in the bathwater out and have the Wild West, but to figure out how to have things that are fit for purpose, how to take off things that are duplicative, because a lot of these rules were written very quickly. A lot of them were really quite sweeping, and yet there's also some new things still coming online, and I'll give, just as a perfect example, is the SEC is looking at ETFs, which is something that we've actually waited for a rule for 10 years. We've been asking for a rule for over 10 years. So we are thrilled that there is a proposed rule. We think it's a good proposed rule, and we put in comment letters, and now we're hoping that they will act in a timely way. So that would be new on top of what's already been done, but it's an example of one of the gaps and things that needs to get done. So hopefully that helps.
It does.
Okay.
Sandy?
So I'll pick up a little bit on some of the capital and liquidity rules, but first thing to lay out there, and I think this gets a little bit lost in the broader discussion, the objective of what we're trying to achieve is financial stability. And financial stability is comprised of safe and sound banking institutions and functioning markets, right? So that's what the goal should be. And in the context of why are we all here in the first place, those two things, functioning capital markets and banking institutions, exist to support the broader economy, right? To help finance homes, to help finance college educations, to help finance autos. So that's what the whole goal is. Now, right post the financial crisis, what actually happened? Oh my goodness, the system, particularly the institutions, were not safe and sound. There were not adequate levels of capital and liquidity. So the shock absorbers of the systems were not big enough and deep enough, and the quality was not enough. So where are we? Because post the financial crisis, and just to, again, lay the landscape, the G20 nations came together in Pittsburgh, and they said, this will never happen again. And we are going to create a level of standard that every investor, borrower, participant in the world can rely upon with regard to the safety and soundness of banks and the safety and soundness, again, of those functioning markets, right? So the Financial Stability Board, the Basel Committee, they set those standards, and then within jurisdictions around the world, in our case, here in the United States, the policymakers, the Fed, the OCC, the FDIC, the SEC, the CFTC, and a myriad of others, take those international standards and implement them. So what does it look like today? Well, when the financial crisis started, common equity tier 1 capital, your most robust capital component shock absorber was at 5.5%. Today, that number is at 12.3% for the large institutions in the United States of America. Not so bad, right? Nearly 2.5 times what it was. Liquidity is nearly 1.5 trillion more than it was. And you'll notice I'm not saying it's too much or too little. I'm just telling you what the facts are related to the situation. What was also good and built in the United States was that thing called stress testing. Have you all heard about that? The CCAR stress test for major financial institutions? Think about what that does. That creates an awesome durability, because what it does, it creates these severely adverse conditions like unemployment jumping to 10%. Right? We're nowhere near 10%. Equity markets dropping by 50%. And on a forward-looking basis, it forces the major financial institutions to see how resilient and robust their capital and liquidity positions are in fact. So that stress testing creates the ability to see where risks may be accumulating and then topping up capital and liquidity. So it's a really good ecosystem. Now, one piece that we didn't mention yet is what else happened? What else happened? Well, let's get to the markets a little bit later, but I want to talk about resolution and recovery. At the financial crisis, shockingly, there were not adequate powers to resolve bank holding companies. Lehman Brothers, a bank? No, not a bank. As a result, no one had jurisdiction, which is why you saw the failure of Lehman Brothers. It did not have access to the window for use of its collateral for pledging to try to generate liquidity. Nobody had authority whatsoever. Post-financial crisis, there is now a framework to resolve bank holding companies, right? There are authorities. And equally importantly, not only did authorities exist now here, they also exist in other parts of the world where they didn't. And we have playbooks. Those are called resolution plans, where you actually look at what is the construct of all of these major financial institutions. What are their entity structures? What are the resources they have around them? How, if they are global, do international regulators engage on evaluating them, making decisions around them, deciding when they're actually out of business? And equally importantly, all of the institutions today have to carry adequate loss-absorbing resources. Why? To ensure continuity of operations. Why does that matter? Think about a firm like mine, JP Morgan Chase. Chances are 50% of you have one of our credit cards in your pocket because we cover 50% of the households in the United States. Chances are if you own a home, you might have, a good portion of this room may have a mortgage with us. Chances are we're moving your payments because goodness knows we move trillions of dollars of US dollar payments across the United States and around the world. We are the largest US dollar clearer. So, can we just stop functioning? No, we cannot. And in fact, not only was that as part of our normal course of business, now post-financial crisis reform, we need to demonstrate continuity of operations, that there is adequate liquidity, adequate capital, adequate ring fencing to make sure all of those items stay open for business, even if other aspects no longer function. And now to give you just a couple numbers to put around it, because I think this is always quite interesting. When we think about that, stress test that I was referencing before, in today's environment, there is adequate capital to cover the losses of all of the 34 CCAR banking institutions by nearly 20 times. So the severely adverse stress test says the banks in a severely adverse stress test will lose about $111 billion. In aggregate, we're carrying nearly $2.3 trillion. JP Morgan alone can cover the entire industry's losses 3 times. That gives you a sense of the scale. Again, facts, no evaluation too much or too little. And we'll come back to opportunities of where there might be adjustments. Hopefully that frames it for you.
Okay. Well, there are courses here about the financial system and about financial regulation, and you've just, in this audience, gotten a very quick course in financial regulation and about the financial system. Can't do it better myself. I'm going to switch to some audience questions because I think they're pretty right on point. And I'll start with one from Jenny Carpenter. Too big to fail has been an issue almost forever. It's, been there forever. We've tried to, one of the ways we've tried to restore market discipline is through creating incentives to work on this. Where do you see too big to fail standing, Sandy? And if there's more work to do, what really should be done?
So look, there are a couple things. You're never going to know if too big to fail fully works until someone actually goes through it, right? But I would posit this. I think the probability of default has declined in a remarkable way. Capital levels are higher, liquidity is higher. You've got resolution playbooks and authorities. You've got things that preclude runs in the derivatives markets. And right now, across the industry, you have loss absorption resources of 2.3 trillion. And you have this new thing called TLAC, which basically is if an organization stops functioning, right, before you even wipe out the capital, you actually put it into resolution. And you've got this underlying debt structure, long-term debt, that ultimately can be bailed in. That's that $2.3 trillion or portion of it that I was referring to, that basically enables organizations to rise up like a phoenix and carry on with their continuing and important operational structures. So can anyone definitively say it will never happen? No, you can't, because you can never say never. You don't know the world you're existing in. But I would argue that this concept of that there are not adequate resources available is just not true. In addition to that, again, that stress testing component identifies where you start to see weak links that might be occurring. And thirdly, the regulatory policymakers and supervisors are engaged in the day-to-day business with every major globally significant institution around the entire world. There should be no surprises. And capital numbers are produced on a daily basis. Again, there should be no surprises. And I think at the end of the day, the big failure, the too big to fail, right, really wasn't driven by size. Lehman Brothers, again, not a bank. AIG, not a bank. Bear Stearns, not a bank. Therein, I think, is a very important issue that we haven't spoken about. You had these institutions that were highly leveraged, doing massive amounts of liquidity transformation that were not subject to the prudential rules of capital and liquidity. Period, full stop. And it was interesting hearing all the 10-year anniversary discussions. Oh, and then the Lehman Bank failed, and then it's really interesting. It's really interesting. The good news is we've scooped all those banking holding companies in, and now they are regulated by the prudential regulator. They're no longer regulated by the markets regulator. So if you ask me, is too big to fail over? I think it actually is. I think that the framework in aggregate has been built to really be substantially more durable. I think the resources are, in fact, in place. And I do not think that anyone has a call on any government to expect to be bailed out.
Great. So you've talked a lot about the regulation that we have, and you talked a little bit about the Fed and its ability to do what it's supposed to do. From Paul Wachtel, we have the question, does the Fed have sufficient lending authority to react adequately when the next crisis occurs? And that has two parts to it, really, because one is to the banking system, but one is to the financial system as a whole.
Yeah.
And maybe both of you want to comment on that.
You take one, go first.
I think one of the interesting things that came out of out of the crisis was the Dodd-Frank legislation, and there was a lot of anger, and understandably so. And that anger was across the country, but that anger also really was reflected in Congress. That's not a good way to be making decisions. And so while it doesn't really directly affect us, we're definitely not a bank. We look at the change in the powers that the Fed in particular has today, and we think that it's a mistake that they have fewer tools today than they did in the wake of the crisis. So, while I understand how they got to where they got in the Dodd-Frank legislation, and it is like plutonium to even touch that legislation and roll anything back, prudent judgment would say it's probably not a good idea to leave your regulator without more tools Doesn't mean they should use them, doesn't mean that they're going to use them, but to have the broadest toolkit available to respond to a crisis, that was what changed the outcome of what was happening. And that's why the US had a better experience, frankly, than Europe and a number of other countries where their central bank either couldn't or didn't act as fast. And I think we had a much better experience and much faster recovery.
Yeah, I would think I agree with that. I think you want as many tools in the toolkit as possible. And I think I worry a little bit, related to both the lender of last resort powers, which are foundational, that's why the Fed was actually set up,
Right.
and the conflation of liquidity versus solvency, right? Because there were institutions that, because the market seized, they weren't able to sort of lend highly liquid securities into the marketplace. And without being able to lend them into the marketplace, and without a backstop of being able to lend to the Fed, for example, that ultimately meant if you can't balance your balance sheet, it doesn't matter how much capital you have, you're done. And again, that nuance seems to have been lost a little bit in the discussion. Lending against treasuries, lending against mortgages, lending against high quality assets with the right levels of margining and haircutting, that's just liquidity. That's not solvency. And I do worry, not only in this aspect, but more broadly speaking, we've made the system more rigid. I think the liquidity rules that we have are actually really good in the sense that, requiring a liquidity coverage ratio, that thing that got liquidity for financing up by 1.5 trillion. So, just quickly, banks all used to be short funded, meaning they used to borrow liabilities to balance their balance sheet every night. Large banks, that is against the law now, basically, right? And well, it's not against the law per se, but if you're going to be compliant with your regulatory mandate, you need to have a liquidity coverage ratio, which means you always have more cash on hand than you do liabilities, and then you take that excess cash and you park it at the Fed. The part that I worry about that's more rigid is the transparency of when you publish that number. So the world of banking is when the economy is going through rough cycles, very frequently you'll hear from the Federal Reserve and say, can you lend more into this economy, right? Can you put more cash into the system? In an environment where you have this liquidity coverage ratio with every major institution needing to be over 100%, think about the rigidity that will create. Is any major banking institution going to dip below 100%? I would argue it will not, because the marketplace and investors won't say, oh, excuse me, before I sell your stock. Are you doing that because you're providing support to the system, or are you doing that because you have a run on the bank? And it's so interesting because the rule is a good one, but the disclosure and the transparency that was booted around, back to the people making rules that may not understand what the practicality of it is, has actually made the system more rigid.
Right. I'm going to ask a couple of questions that are specific to you individually. So the first is related to money fund reform. And Barbara and I went through that
I love it.
together. And so there are some proposals to reverse the money fund reforms that were put in place in 2014. We would both agree that they're far from perfect, but we can talk about ways to improve them. How would this affect the resilience of the financial system, and what should be done, if anything?
So let me first give you a little bit of history so you know what's been done and then what's on the table today. I think that would be helpful. So during the crisis, there was a money market fund called Reserve Fund, and they what's called broke the buck. At that point in time, all money market funds had a dollar NAV. You put a dollar in, you got a dollar back. Might get more or less interest over time, but the concept of put a dollar in, get a dollar back. Similar to bank deposits.
Yep.
Not the same as, but similar to.
Although that was the issue. Too many people thought they were the same as.
That was
the issue.
Okay, so they broke the buck, and all of a sudden, investors all over started saying to other companies, I want my money out of my money market fund, because I don't know if you have the same problem that Reserve had. So even firms that had no problem, even vaguely similar to Reserve Fund, suddenly found there was a run on the bank. And with this dollar NAV structure, that was a problem. After a few days of this, and it was obvious that this was going to break more of the system, the government did step in. They put an insurance program in place. They did a whole bunch of different alphabet soup programs, but I think the most meaningful one was they put an insurance program in place, which if you really read the fine print, it was at best a fig leaf, and not a very big fig leaf. And it said that your balance as of a certain date would be guaranteed, but it didn't say anything about new money getting put in. The mere presence of that program turned everything around. All of a sudden there was investor confidence. Oh, the government is noticing, is caring, and the same exact people who 1 week before took their money out of prime funds, so those are the ones with commercial paper and other things, took their money out of prime funds and parked it in government funds. They didn't need their money. They didn't have a use for the money. They just didn't want to keep it in the prime funds. Those same people called up and they moved their money back from the government fund to the prime fund. So you know that it was a crisis in confidence, not a true liquidity crisis per se. But of course, looking in the rearview mirror, people were not interested in having that happen again, us included. I think we were the exception in the industry, but us included. So there was a very rapid response, and there was a series of changes made in 2010, which were at the portfolio level. Increase the credit quality, shorten the maturity, increase disclosure. There was a whole package of things. It was done with very little fanfare. Industry worked closely with the regulator. I think the package that came out was a very good package. But in the release, the very last thing that the chair of the SEC said was, and we'll be back to do more on structural reform. Well, that was when all hell broke loose. Well, it turned out that the Fed and the Treasury and the SEC each had different ideas of what the outcome should be, and industry had yet a fourth idea. So that didn't make for great dynamics, group dynamics of the worst kind. And after much back and forth, and actually several SEC commissioners in the process, eventually the department at the SEC that is responsible for economic analysis was allowed to publish a report which showed the actual cash flows across the industry in the crisis. And suddenly the framework for an agreement emerged. And the agreement was a rather complicated one, but it said retail investors didn't really run, so we're going to leave retail funds alone and they can be a dollar NAV. How do you prove your retail? Well, a social security number and 100 other things that you could have, but you're either an individual or you're something else. For the people who are something other than an individual, and that could be small institutions, it could be any kind of entity, they have to be in an institutional fund. And institutional funds would no longer be allowed to have the constant NAV. So they have what's called a floating net asset value. So lots of fanfare, a very long implementation time, gave people an opportunity to educate clients, gave clients an opportunity to decide which way did they want to go. An enormous amount of work went into it, came out the other side. It was the smoothest, best transition. You will not read a single story about the transition because literally the day the switch turned, nothing happened, which was perfect. No destabilization, no problems. Roll it forward. There was one firm that was extremely strident throughout the discussions that anything less than absolute constant NAV was not acceptable. That firm is still very actively lobbying that point. They've created an amazing campaign. Do you have any marketing students in here? This is the most brilliant marketing ever, okay? They went out to municipal treasurers across the country and they convinced them of two things. They convinced them that their borrowing costs had risen because of money market fund reform. Forget that the Fed's been raising rates. It is because of money market fund reform. You are now paying a higher rate, okay? Then they also convinced them that their investment opportunity set when they have cash is worse because of money market fund reform. They can only invest in constant NAV funds, and therefore they're investing only in government funds, leaving all this money on the table. So they're getting hit on both sides. Higher cost of borrowing, lower cost of return on investing. So here's the actual facts. The Fed's actually raised rates quite a few times, and that's the number one contribution to the rise in municipal interest rates. We did a survey, actually ICI did a survey, 48 out of 50 states allow their municipalities to invest in floating NAV funds. Yeah. So if the treasurer wants to, he can. Unfortunately, they've convinced all these people. So what do these treasurers do? They in turn around and lobby their local members in Congress, Senate and House. And literally there are stories of someone being at the state fair and, on a home visit and waving the flag and being accosted by municipal treasurers, smaller municipalities, and what are you going to do about this? So there is a proposal to undo money market fund reform. We think this is one of the worst policy ideas ever. This was a data-driven regulation. This was done for a good reason. There was a need, and the whole market adjusted to it very nicely. So we've written some nice, we call them viewpoints. We've written some nice viewpoints, and we have pushed rather hard back to try and get facts on the table. We've suggested a compromise, which is if you really think something's not right, have the SEC do a new study, have them look in a rigorous way at how did the market adjust, were there any unexpected, unintended consequences that were negative, should the language be tweaked, but let the SEC, which is the proper regulator, do that work and come back with a recommendation. Let's not have Congress in some 11th hour strange move undo what took years to get to. I can't say that won't happen, but I'm hoping that won't happen.
And look,
fingers crossed.
Just back to this. So my firm has a large asset management arm as well, and we agree completely with that. It should not at all be shifted or adjusted. And I think one of the real things that was very correctly identified here is, luckily no leverage in these kinds of funds. Unluckily, lots of liquidity transformation and an expectation by investors that they had full access to their money at will. And therein was the issue. So in fact, getting to a floating NAV and getting to a better understanding that this is not a demand deposit. It is different than a demand deposit. And consumer education, investor education really matter. The one thing that Barb didn't mention, which I do think is pretty extraordinary, there was a movement of folks out of floating NAV because they didn't want to deal with floating NAV into government funds. That was $1 trillion shift happening seamlessly as predicted. And by the way, if you want high levels of demand on your money, probably the best thing to have it invested in is U.S. government securities, not a spectrum of broad commercial paper issued by a variety of international players. So, again, very smooth transition on that, but very important that liquidity transformation, expectation for when you get your money, and that lack of understanding was a fundamental issue.
Yeah, and I would just end by saying, we've talked a lot about product and activity regulation. This is a good example of product regulation that makes sense, right? It's not taking one fund, it's not taking the 5 largest funds, it's not taking the funds from letters A through N. It's saying this is a product that has an interesting structural feature, and we need to address that. And we need to address it for all providers of the product. Because if you change it for one, but not for the others, money's just going to move around. You're not going to address any kind of systemic risk. So this is the poster child. The Treasury talks about it, and they hold it out as a good example. So, we're really very much hoping that it doesn't get undone.
Great. Another example of product-oriented regulation is the one that U.S. and other regulators around the world are aiming at transitioning away from Libor as a reference rate. So Sandy, tell us why they're doing that. Is it feasible? What are the transition issues? In 25 words or what?
No, just
I can't do 25 words or less, OMG. So let me just say, yes, I think it's feasible. And despite the fact that Libor is so well entrenched in the marketplace, Libor's younger than I am. So that's, it hasn't been around that long. Not quite when dinosaurs roamed the earth, so I think we can live without it. So what is the issue? The issue is this. The London Interbank Offered Rate, which still now exists across 5 currencies, 7 maturities, really was about where banks borrow and lend with each other in the short term. Remember my comment earlier? Do we borrow any money in the short dated anymore? No, right? Because guess what? You're all long funded now, so there's no real short-term exchange of funding between and among banks. And Libor existed when there were it was produced when there were a lot more transactions. And because it was sort of, what do we do when things are easy? We start referencing them, right? So this benchmark is now used. Anyone want to guess for how many in notional values? $200 trillion are referenced off of the US dollar Libor rate. How many transactions do you think happens in each day on average in 3 months, which is the busiest one? Any guesses? 5 trades. 5 trades are happening on average every single day. It is the biggest inverted triangle you've ever seen. On average, total value is about $500 million. Houston, do we have a problem? 200 trillion off of 500 million. So, how does Libor get calculated? Well, you've got these panel banks that submit what they think Libor is, and it's supposed to be transactions-based. Well, if there are only 5 transactions and there are 16 panel banks, not enough transactions to go around, my friends. So, in fact, they have to use expert judgment. And therein is the instability of the rate. There is an awful lot of risk to use expert judgment on setting a rate for $200 trillion. So that's not really very good. So what did we do? Well, first thing, if you're going to transition away from something, what do you need? Something to go to. So this public-private partnership that has in place with public policymakers, set up by the Federal Reserve Board, the Fed, the CFTC, the US Treasury, OFR, we came to the table to identify a new risk-free rate as an alternative to Libor for use in derivatives. And we came up with this rate called the Secured Overnight Financing Rate. It's a repo rate. It has transactions, daily transactions in the overnight of $750 billion every single day. And it is now produced by the New York Fed. No submitting banks. No expert judgment. IOSCO compliant for those of you who are geeking out like I do and understand that that's a standard setter, and they tell you all the good characteristics of a benchmark that people are going to use. So it hits all of those wonderful things, right? Which is really, really good. But when you build a market, we have a rate. We got to now make this, and when the rate was born April 3rd.
Is that your birthday too?
No, but it's up there with my kids. April 3rd, we birthed the rate. But in any case, now next thing you have to do is build a derivatives market, because you have to build a derivatives market so you can get some transaction flowing so you can see what liquidity is. So on May 7th, we launched 1- and 3-month futures tied to SOFR. We've subsequently launched basis swap trading. But we created this transition plan to build this marketplace. And it's a bunch of all of the derivatives houses, the central counterparty clearers, a couple of market infrastructure folks, and the ISDA, they do the swap documentation. And so we've built this framework and embedded in, because when you want things to be voluntary, not voluntold, you have to make the path gradual and put in a draw. The draw is ultimately, across all of the CCPs where we trade all of our standardized derivatives, we're going to move the discounting rate and the price-aligned interest rate to this new rate. That will lock in a requirement to use this rate on, what was that number? 200 trillion, right? So that ultimately will drive demand. In addition to that, you may or may not seen, but look for it if you haven't seen it. We worked with Fannie Mae, who launched the first SOFR-linked floating rate note. 3 tranches, $6 billion, which, by the way, if someone's issuing it, what does it mean? Some investor is buying it, which is a good two-way market, and that's how we're building, again, demand from that side. But there's an awful lot to be done, because while that sounded really good last year, Andrew Bailey, head of the FCA, who is overseeing Libor and its administration, said, I have been basically shackling those 16 banks into submitting that LIBOR rate. And as of the end of 2021, I am not going to use my supervisory authority to compel them to do that. So what does that mean? That means LIBOR could come to a screeching halt. And if it comes to a screeching halt with a cliff effect, well, now we're not just looking about what the new activity should be. Now we need to figure out what do we do with all of those old contracts which haven't rolled off yet. And so one of the exercises we did as an industry with a whole bunch of new members of the ARC across every single segment, including the consumer segments, because while the 200 trillion is mostly derivatives, 10 trillion are mortgages and securities and floating rate notes. We looked at the contracts. And I'm just going to tell you about the derivatives contract. You know what it says to do if LIBOR stops in that $190 trillion of derivatives contracts? It says, well, if you can't get a rate on a screen, call those guys that were supposed to submit that rate, and they'll give you one. It really is not set up for a permanent cessation of that benchmark. And now think about this. That's where it stops. So if we don't fix the contract language, then if LIBOR stops, what will the $200 trillion worth of notionals, those interest rate contracts, be charged at? You expected to receive something, what's the number? You expected to pay something, what's the number? The number is we don't know. So therefore, a lot of work has been done on getting proper contract fallback language in place. There's a lot of important work that needs to make sure that there's a minimization of the transfer of value that could occur, because it's not supposed to be creating a windfall for anyone, particularly our retail consumers across the entire globe, because they said it's 5 contracts, 5 currencies. So a lot of work is being done there, but I am very optimistic that it will work out, because the last couple of months, Mr. Bailey spoke again. You know what he said? And I'm sure many of you studied this in your classes. The end of LIBOR is not a black swan event. It is a likely outcome, so you better be ready for it. And the reality is people will be getting ready for it, and you need to participate, and no one can be a bystander. So that's what I spend a lot of my day job doing these days.
Sandy's very modest. She has led a campaign. She's voluntold everyone. Voluntold everyone to get with the program.
Absolutely.
But it's a Herculean task, because there are all these old contracts, and while every new contract, the language is crystal clear. Yeah. We estimated 36 trillion just in US dollar LIBOR maturing later than 2021.
Right.
So there is a huge embedded book of long-dated interest rate swaps, as well as mortgages and other things that are tied to LIBOR, and they do not have language that you can fall back. So you get into a very big legal quandary of, well, who gets to pick what the number is? You know, if I'm the borrower, I might want the lower number. You know, you want the higher number. So we're talking about massive amounts of money, and that doesn't make people very friendly if they're in that situation. And we can't let it wait until we fall off that cliff. So one of the starting points is the banks are certainly acutely aware of the situation. I would say most large asset managers are also acutely aware and very involved in the committee and the ideas coming out of the committee. Where it falls off is our clients. So the average pension plan, the average sovereign wealth fund, certainly any kind of retail investor, people who are investing with us, they are in desperate need of more education. We've again written about this. We've sent things out. Oliver Wyman recently wrote a nice report. We sent that out. The education of the end investor
is huge.
Is not there yet, and it is a daunting task. And without that buy-in and that education to get there, I don't know how. No,
the good news, a couple things. One, we've done 3 roundtables, 2 papers, consultations, and we put contract language out into the market for commentary. And the committee is now covering vast swaths of participants, again, including, folks writing mortgages, for example. And you guys also have the privilege of having in the room this gentleman right over here, Andrew Gray. Andrew Gray is one of the lead comms people at JP Morgan, and he is actually the co-chair of the ARC Committee on Communications, because we are running this like a line of business, because communication is absolutely so fundamental so that people do understand what the intent is, what the direction of travel is, how we're trying to make sure we have the best possible outcome for every participant, and how collectively with the public sector we are trying to preclude, again, any windfall events. This is about a financial stability risk that we are trying to protect against. Nothing more, nothing less, and that is what we are in this thing to do. So that's the guy that's going to make it all happen so that we can deliver it.
And I would just add to that, Sandy's leadership has been leadership on a global basis, because the U.S. has led the way in this, and other regulators around the world are following in fairly short order.
You're very kind. Go NYU. That's where all my skills came from.
There you go. So let's switch gears a little bit and talk about where do each of you see the biggest short-term and long-term risks to the financial system. This is from Nicholas DeRose.
Well,
that may speak to some gaps.
right.
That may speak to some, vulnerabilities.
so the number one on my list is actually the transition of LIBOR.
Oh, really? I got this.
I think the future of LIBOR, it's going to happen, right? It's not a if. It's not even a question of when. We know when.
We know when.
Yeah.
We know when. We know if. We know it's happening, and yet I do worry that
Yeah,
not everybody is going to be ready, and that could lead to some very challenging problems. Second on my list is something called CCPs. So
Yes, we shared this.
one of the ideas that came out of the crisis was the opacity around derivatives, and especially swaps, was problematic. Like, nobody even knew what AIG had.
No.
And
Or that they had a book like that.
or how big it was, or anything about it. And they weren't the only one. I mean, they were the poster child. But the decision was to not create the CCPs from scratch, but to basically mandate the use of CCPs for a lot of clearing, which was a good thing.
Yeah.
However, you cannot magically take risk out of bilateral trades with banks, and poof, you put it in a CCP, the risk is gone. It just doesn't work that way. So when the CCPs were designated as the entity for clearing, well, it cleared up the opacity problem, and it standardized collateral and haircuts and lots of good things. What they didn't do was address resiliency.
Yep.
The immediate discussion was about recovery and resolution, and I started saying, wait a second, I think there's 3 R's and you've missed one. Resiliency. Where's the capital? Where's the disclosure? Where's the supervision? Where's the governance inclusive of people who are at risk? And the answer is, it's not there. And interesting, we had a new paper, kind of an update. It was like it was a 10-year look back, look forward paper, and it was all ready to go. And literally, a CCP blew up. And it was exactly what we keep saying. We're really nervous about exactly this. It blew up. It created some losses. Now, it wasn't big enough to be systemic, but it was disturbing. And we said, hold the presses. We need to understand what just happened. We need to see, what lessons can be learned and incorporate those. So we ended up holding up the paper a week or two. We put that paper out. Instantly, we had incoming from policymakers all over the world saying, okay, we need to know more about this. So we're hopeful that, a crisis is too good to waste here. If you've got a problem and you've got an example, let's use that to push why resiliency is so important and get some of the things that we want. So that would be second. The third one on my list is cybersecurity.
Yes.
And you guys are a different generation than me and Sandy. And, you probably think that, walking into a bank is like this really old-fashioned thing and you do everything on your phone. And my kids are the same as you. In fact, they're exactly the same as you. And to me, that's like horrifying, that everything would be in this electronic sphere and there would be no real hard anything. It's a generational thing. But what you're really comfortable with comes with enormous risk. And I'm too old and too fuddy-duddy to want to take on that kind of risk. You guys can do it, and that's okay. So everything to do with cyber is somewhat scary because we never know, and then we read about these things, and I know what defenses we have in place as a firm, but this is system-wide. One of the worst things was when SWIFT blew up, and here the Federal Reserve of New York, you would think, would not have an event happen to them. But somebody, broke the codes, started sending in requests. It was over a weekend. I guess it was a junior person, wasn't really thinking. They're processing one after another. Millions or billions of dollars later, never recovered, never can be recovered. The money's gone. And that was a great example. An old system, code was written, God knows how many years ago. I think that was before you and I were born.
Clearly.
Not like Libor.
Not like Libor.
And any kind of antiquated system, it was such an obvious target. I even wrote about it in letters saying I would be concerned about X. X was SWIFT by name, because it was just such an obvious vulnerability. So, I think when you look at cyber, that's a big one. I would include on my list exchange-traded products.
Yeah.
I'm going to differentiate that from exchange-traded funds. And here again, crises explain a lot. In February, there was a big volatility event, and there were some products that literally people lost all their money. If they didn't lose all their money, they lost 90% of their money. May as well have lost all their money.
Yeah.
And we have been saying for years, literally, inverse products, leveraged products, these are extremely different than a basic vanilla long-only ETF. Don't let people call them ETFs. We haven't won that battle yet. I'm hoping in this new ETF rule, we're going to continue pushing. I'm hoping that we'll make some progress. We've made a little in that the new ETF rule won't apply to the leveraged and inverse structures, but that's not really enough. We want to change the naming convention, not allow that. Because there could be contagion. People see something go wrong, they hear it's an ET something, and then all of a sudden, mayhem. So I'll add one more, which Dick knows is my absolute favorite, which has to do with cash investing. So all this, hoopla around money market funds, similar hoopla about some of the bank short-term investment funds. And I say some because we have a very bizarre regulatory system in the United States. The OCC regulates national banks, national chartered banks, but state banking regulators regulate all these state chartered banks. So the OCC very early on said, oh, the SEC just changed the rules on investments. We better do something too. And they did something, and it was fine. It has never been applied to the state chartered banks. When you look at the largest custodians, the largest pools of short-term investment funds, they're all state chartered banks. So the vulnerabilities that we actually saw in the crisis have yet to be addressed. I don't understand why. Maybe somebody close to FSOC can explain that to me.
It's a coordination problem, Barbara.
Right, it's a simple letter that needs to be written asking the bank regulators to look at this and do something, but 10 years later, they haven't. So that is, I actually think, a serious vulnerability because those pools blew up. Pension plans lost millions and millions of dollars in those pools in security lending. Those pools have not been addressed. So that's my last one.
It's not like we didn't address it around the table.
Okay, so I'm going to agree with a couple of those and have a few to add just from a different perspective. On the CCP, so I do think with the NASDAQ Nordic, we have a beautiful little case study that's a really inexpensive lesson and gives a perfect example on where transparency and resiliency are critical. I think, one, I agree completely with getting to standardized approach to clearing derivatives is a really good thing. You get netting benefits, you've got transparency typically into what ultimately is going through the exchange. You have the ability to sort of identify. But what happened was, as we zoomed to do this, we ultimately, I think if we had a retrade collectively, including the policymakers, we probably would have considered making them utilities. But the reality is we're half-baked. We've got a for-profit CCP at the front end managing the components around governance and the resources provided by the clearing members. That's pretty good. I'd like that trade at home, right? So what does that mean? That means you really need to understand, do we have adequate shock absorbency? Barbara's comment around skin in the game, right? A CCP in and of itself cannot have enough of its own capital because they don't make enough money to have its own capital. They're not going to have the kinds of numbers that we just talked about, 2.3 trillion in the banking industry. But that's a starting point. So where does the other shock absorbency need to come from? It needs to come from appropriate margins, supported by appropriate collateral, and ultimately adequate default funds, which are in fact funded by the clearing members. And how much is in that default fund is driven by what is the stress testing, which can make sure that you can cover the default of your 2 largest members. That's typically what happens on most CCPs. So the real question here for this little smaller CCP is they had a high concentrated position in a single individual human, not a company, a human, that went wrong way and not only wiped out the skin in the game of the CCP, actually blew through a good portion of the default fund. Well, how's that cover 2 working out then? That's, I mean, just a question, right? It's just a question. And then how do you refund that default fund? Oh, hello, clearing member, can you top up the default fund? We're sorry we blew through it. We've got a disconnect between how the stress testing is run and the transparency and the concentration risks, where you can have more of a collective view, which is exactly what Barbara is saying. And then, you know, the reality is there should not be unlimited liability anywhere where a phone call is made and everyone has to cover the losses for lack of governance. I would add to this to just make it a little bit, now not about the Nordics, but broadly. We haven't even talked about non-default losses at CCPs. Back to that cyber risk. What are the adequacy of the resources on non-default losses? Think real cyber risk. If someone attacks the infrastructure, where does that come from? And that is not yet in play, and that's under serious discussion with policymakers around the world. Let's come to cyber. I agree with you on the whole age thing, but that's in my head, that's not even, because God knows I'm old too. I can't even deal with all of the stuff going on. But the reality about cyber is, think of what's happening. It's not, you know, there's little c cyber and big C cyber. Little c cyber is, well, since there aren't as many branches in the world as there used to be, there's little c cyber, cops and robbers. Bank robbers go in and steal things. You deal with those, you fix them, you move on. But then there's big C cyber. And that is the folks that are out there, including governments, that are acting with an intent to harm. An intent to harm, an intent to take down financial services. That is what we obsess over, right? And by the way, what's very unique about managing these risks is that we and the policymakers actually need to be on the same side, because it's the bad guys against us. That's very unusual, right? It's a very unusual framework for thinking about regulation. Usually you're being told what to do, but we are on the same side of it. And then you have the added issue of it's very hard to get to sort of a standard approach in thinking about it, or information sharing in this day and age of privacy, right? Particularly since, remember what I said? Governments are involved in this. So you've got the national security component, but then you've got the supervisory approach. We need to have a general standard of expectations for every participant in financial services. So back to SWIFT. Not only was SWIFT old, think about existing payment systems and any other kind of infrastructure out there. People have been hooked onto it as that technology was developed. It could be 80 years old. Well, how do you make sure everyone has the right standard today? And by the way, we don't have an alignment of interests here. Cyber is expensive. Protecting against cyber is expensive. Getting the right people in the room is expensive. We spend, at my shop, $700 million a year doing this. We have 1,000 people who all they do is cyber. That's all they do, right? And I'm not even going to say that that's enough, because the reality is, you know, you have to figure out what is the right level to get you to the right standard, and people and capabilities and talent matter. And guess what? If you don't know it, and if you haven't picked a major yet, there aren't enough cyber experts. We, in our schools, are not producing enough. You talk to any chief investment officer of anyone in financial services, and they will tell you the gap is big today, and it is getting wider. So if you want full employment, that's the kind of role to be thinking about if you like technology. Come to us, we'll hire you. So that's the second one.
That and compliance.
Yeah, well, that's not that's not my issue.
We can talk about that.
I got cyber. No, but it's true. No, but you're absolutely right. I think, you know, on a less scary perspective, I worry about things like, you know, market liquidity, our rules as they're written, they're not really, our prudential rules aren't always thought of in the context of their impact on markets. You've seen a decline in the repo market, you've seen a decline in liquidity, you've seen changes in investor behavior, we're much more a buy and hold culture with the quantitative easing that we've been going through. So the day-to-day requirements may be making us a little bit numb because day-to-day liquidity requirements are lower than they have been in a long time. But I'm not so sure what that flex in market depth is. And we know even in something like the Treasury market, market depth is substantially lower, meaning, let's say pre-crisis in the 10-year sector, you'd have to trade more than $500 million aside to make it move a basis point. Today that number's $200 million. But guess what? The amount outstanding has quadrupled since that point in time. So that really means you're going to get a lot more price volatility in the U.S. Treasury market. And what does that look like? Because remember that thing we talked about at the beginning? Liquidity coverage ratio, high quality liquid assets. What do you think all the major institutions around the world are holding? We're all holding treasuries if there is a liquidity issue. And what do you do when there's a liquidity issue? You need to sell the security. And if you're selling the security, who's going to be able to buy that size on the other end? And I think those are the kinds of things that we collectively think about. So fragmenting markets is a contributor to that as well. And I guess I will end on the, I worry about the fact that I think, at least in my lifetime, the world will only continue to become less global with regard to markets and financial services. It will remain international, but it will be less global, right? And we used to have really good flow of capital, resources, money moving across jurisdictions from those who had it to those that needed it to get to the best ideas to create broad-based opportunity. And everyone's getting much more isolationist. That's not good for global economies. That's not good for opportunity for all. And I worry about what that means within countries in that context. So that's what I worry about.
All right. You alluded to earlier the reports the Treasury was putting out, and they're now complete. 4 reports, 3 memoranda, taken as a whole. They're looking at the same question I opened the discussion with. Do we have the balance right between resilience, safety, and soundness on one hand, efficient, effective, appropriately tailored on the other? Having talked to you, I know that your views are, they pretty much got it right. But can you give us some examples of where you think they particularly focused on maybe some of the unintended consequences that needed to be fixed, or some of the things that they missed in this discussion, which we ought to pay attention to?
So to put it in perspective, I tell people who start at BlackRock, they should read the Treasury report specifically on capital markets
Right.
as a primer.
Right.
Yeah.
And I would
Excellent.
recommend it to everybody in your program. Anybody who tells you, gee, they're getting nothing done in Washington and blah, 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 they're just not paying attention to what is getting done. So the Treasury used their time wisely. A lot of seats were not filled, and very little could get done. And they used that window, and it was a good year-long window, to study different aspects, banks, insurance companies, asset managers, funds, all sorts of things. They came out with this series of reports. They are exceptionally well done.
They're wonderful.
And they go so far as to give very specific recommendations. Most of them are ones that can be addressed at a regulatory level.
Which is important.
Yes, some of them require
As opposed
legislation.
to legislation.
As
You've
opposed
probably
to
noticed
legislation.
that Congress is dysfunctional. That would be kind. But a lot of the problem, a lot of the overreach was at the regulatory level. So it can also be reversed at the regulatory level. Each agency has a different list. Some of them are cross-agency, like a Volcker rule. But some of them, certainly the SEC's list, included things like get out a rule on broker conduct. And that was long in coming, but it's come. They had something on ETFs. That's now proposed. They had something on liquidity rules for money for mutual funds, bond mutual funds. That's been completed. They had something on e-delivery, the use of electronic delivery instead of wasting all this paper. That's been completed. So there's a very long list of recommendations. There's hundreds of them. they're not all for any one agency, but they go across the different regulators. And each regulator is prioritizing and is marching down the list. None of them are rip it all up and start again. None of them are go back to a Wild West. They're actually really thoughtful, and the guy who is heading that whole area is a very clearly avowed Democrat who sort of fell into the position, and he's not a partisan guy. He's serving because he thinks he can add value, and we're very lucky to have someone like him in that seat. And I would say the same of people who are at the SEC, exceptional group at all different areas of the SEC. Same thing at the Fed. So in financial services, what we're seeing is really incredibly dedicated people from all different party backgrounds, and it's not a partisan crew. It's very much a, what needs to get done, how do we make things better, and definitely not go back to a Wild West.
Yeah, no, I agree. I think, I call it myth busting. People use the word deregulation. That's just not true. That's not what's happening. If there's really any aspect of deregulation, it's for community banks, and I would call that making rules proportionate, right?
Right sizing.
That's right sizing it. Those organizations don't require that standard, and they don't have the resources to support, the effort, and resources, both money resources and personnel resources. So that's really what's happened, and that's what's actually been pushed through legislation. Where are there sort of opportunities? Things to need to think about. For the largest banking institutions in the United States, remember I said earlier, we start with international rules and they have to get implemented here. One of the big rules that came out of the Basel framework is the GSIB surcharge. And the GSIB surcharge really is meant to protect against the systemic risk the largest institutions create because they are so interconnected across the entire globe. And the starting point, it comes from a very good place, right? It was built, as people were coming out of the crisis, and, it ties to things like interconnectedness, cross-jurisdictional, use of derivatives, short-term wholesale funding, made a lot of sense. And that baseline, while there's still, areas for improvement, which I'll come to, in the United States, what did we do when we implemented it? What do we do at McDonald's? We supersize, right? That's what we did here in the United States. We took the international standard and we multiplied it by 2 without any empirical analysis to justify why that occurred. So the question is, how come? And that's where the discussion is right now. When you talk about the Treasury reports, it's sort of let's evaluate the calibration of that, particularly in the context of all of the other rulemaking that's occurred. Now, why do you care? Why do we care? We should care because at the end of the day, you want to make sure that your system is safe and sound. But every incremental dollar beyond safety and soundness is a dollar that's not deployed into supporting economic growth. So this double sizing here in the United States for the largest institutions is about, just on this surcharge, nothing else, about $50 billion of common equity Tier 1 capital, which equals about $600 billion worth of loan equivalents. Money that can be lent into the economy. That doesn't mean dollar for dollar that would be lent, because that all has to do with risk appetite and underwriting standards, but it just gives you a sense, and that there's no basis for why this number is so much higher here. In addition, and by the way, the Treasury report put that out. In addition, all of the rules that we're talking about were written simultaneously and across jurisdictions by everybody who was looking at the abyss and trying to solve the problem. So really the opportunity here, again, is not deregulation, but calibration, and now let's look at coherence. Back to that GSIB surcharge, and let's talk about short-term wholesale funding. One of the big issues was too much liquidity transformation, right? And an inability to roll over short-term funding. But we have this new rule called liquidity coverage ratio, which makes sure you're not funding too much short-term. And we have this new rule called the net stable funding ratio, which makes sure you're not funding too much short-term or medium-term. And we've got this new rule called total loss absorbing cushion, which makes sure that you have adequate long-term debt, right? And we have margin requirements. And we still have in this GSIB surcharge a short-term wholesale funding buffer that doesn't take into account your compliance with any of those. And similarly in that buffer, it never accounted for credible resolution and recovery plans, which are de facto put in place and resourced and have adequate cash and capital around it to make sure that your systemic footprint no longer impairs the broader economy. So that's where you have real opportunity. Where we still, aside from the tweaking, things that make you go, and let's take a look at, I worry a little bit about equity capital formation and how it's occurring, right? Not as many public offerings in the United States. Guess what? There's plenty of private capital getting put to work. So one could say, well, who cares? And in fact, that was the first reaction the first time I had that conversation. The big ideas are getting the money, so who cares? Well, okay, but how do we create wealth in this country? You create wealth in this country by being able to invest in our equity markets and participate in great ideas. If all of these great ideas are financed by a very small contingency, well, now are we really delivering on our public objectives, our public policy objectives of broadening economic growth across the United States? So we need to look at how come we're not doing as much public offering. And what you'll hear and you'll find is the burden of going public is extraordinary. Even those firms that go public much later in their life cycle. The requirements around reporting and Sarbanes-Oxley are really outsized for those institutions. And, in some cases, they're concerned about, well, our activist investors are going to start telling me what to do. We've got to find more balance. So those are, again, opportunities that we can look at, but things that make you pay attention, because our equity markets are functioning and money is getting to where it needs to go. But is it doing it in the way that we think serves most Americans? That's a question.
I'm going to close since we are running out of time, but we have one more question, which is also opportunistic and opportunity creating. And that is, one of the new things around is fintech, cryptocurrencies, et cetera. Now, the last Treasury report addressed those things in part. And the question for you is, how should we think about oversight and regulation for first cryptocurrencies? If you want to touch on initial coin offerings, I'm happy to hear about that too. But just fintech in general, what do you think should be done here?
Okay, so first thing I'm going to say is fintech and cryptocurrencies are completely different.
Correct.
Okay, fintech, I could tell you lots of good things. We could go on for hours and hours, and ways that technology
Don't
is
scare
being
them hours and
used
hours.
either to make your operation more efficient, to give a better user interface to customers, to get better investment decisions. There's a host of examples. But now let's talk about cryptocurrency. So I have to tell a funny story. Last year I was at a event, and it had a lot of media at it. And Jamie Dimon and Larry Fink, who are our respective bosses, were on stage, and they were asked this question.
Yes, they were.
And it was like someone pushed a button, and Jamie said lots of negative things
not in the script.
about Bitcoin and cryptocurrency, and he just couldn't stop. And he got to the end where he said, and my daughter actually bought some of this, my formerly smart daughter. And that's all, that's all public. There's a nice transcript about it.
You can read
and it was right before Thanksgiving, so we all got a good laugh of what
Thanks for that,
Thanksgiving
by the
dinner
way.
would be. I'm sorry. And Larry just sat there, so happy that somebody else was answering the question.
He was thinking it, right?
So I'm thinking about doing the same thing here, but...
Letting me do it? Yeah, no.
You don't know.
You're going to go.
What we have, I'll bail you out on this one. We've looked at this. We like blockchain as a technology. We think there are use cases for it. In fact, there's a part of this capital formation discussion that Sandy talked about is the SEC is looking at what's called proxy plumbing. How do you vote? How do people get from owning shares to actually voting in companies' annual meetings? And it's a nightmare of a process. And that might be a really good use for blockchain, and people are looking at that. So there's a whole host of possible uses for the technology. Cryptocurrencies, on the other hand, if you buy them, good luck. They're very volatile. I know some people who have tried that. They say it's really easy to buy. It's not so easy to sell. And they were a little surprised by that. So they got in, they thought they had something, they thought they knew the value, then they tried to get out, couldn't get out. Of course, by the time they got out, the value had gone down. That's called a Ponzi scheme. I don't think that's a really particularly safe or clever investment. There's certainly evidence that there's a lot of illegal behavior or illicit activities, and whether they're illicit countries or they're illicit businesses, there just seems to be something about them that would argue against getting involved. Now, I'm sure there are other people who take the other side of that. Sandy, maybe.
Maybe, in fact. No.
Or she's going to say that bell rang.
No, this I have to talk about this. Can I talk about this? Will you guys tolerate me for a couple more minutes?
Yeah.
Yeah. Okay. Good. Thank you. So let's start with crypto. What's very interesting, and again, I think you nailed the DLT, distributed ledger. That's very, very interesting. Cryptocurrency is really interesting. So if you take it, in my view, I would step back and think about it from a public policy perspective, right? First, we haven't defined what it is. Is it a currency? Is it an exchange of value? Is it a security? What is it? Or is it a speculative instrument? Then the second part I would say is from a public policy perspective, we care so much about how investors invest and whether or not certain investments are suitable, right? You have how much is going on in your shop, how much going on in my shop. We have to figure out if you're capable of investing in a U.S. Treasury bill. But what's interesting, because of the technology involved here, you've got crypto going direct to consumer, direct to you guys. So do we no longer care about suitability and appropriateness? Because as Barbara said, this is an extremely volatile thing, and we haven't even defined what it is, right? And what happens if you go out and you use all of your money and it's gone? Now, again, by the way, we let people go into casinos. So I'm not telling you what I think the public policy answer should be, but I do think there's an important question here about how do we want to think about cryptocurrency from a suitability perspective and a consumer protection perspective and an investor protection perspective. Now, separate from that, there are some central banks that are thinking potentially of not crypto, but how do you potentially use fiat currency in sort of this kind of framework. I will tell you, one of the items on which the basic theory of cryptocurrencies were launched was 100% anonymity. Here's another public policy question for you guys. Do we care about human trafficking or not? Because we have lots of anti-money laundering and know your client all through financial services to make sure we don't support terrorist financing or human trafficking. And that is a very open kind of architecture. How can we get comfortable with moving money as a store of value without knowing what the provenance of that money actually is? So cryptocurrency, as initially thought about with 100% anonymity, cannot work if we believe in the public policy issue that I just raised. Now, that said, could there be a framework that we think about it's open somewhere where you're not anonymous to someone? Maybe it's no longer, it's just that you're not anonymous to a bank. You might be not anonymous to an exchange or a government entity, whatever. But it can't be 100% anonymous if that underlying theme needs to still be met. So, and I think what's also interesting, the conversations around, it's a democratization of the exchange of flows. Really? Because it's 80% held in one jurisdiction in the world. Just saying. And the question I would next ask is, it's 80% held in that one jurisdiction, and maybe that's because it's innovative and it's startup and it's drawing on all the electrical power in that part of the world. Saying. Because that's how it works, my friends, mining. So then, therefore, how are you going to make sure that when it really becomes or could become more democratized, you break up that power base so that, in fact, because what happens when you have the power? You can change the supply. When you change the supply, you change the value. Remember Economics 101? Yeah, I remember Economics 101. So there are a lot of questions in here that need to be thought about. So it's not so simple, love it, hate it, but I think there are important policy questions around it, and important, how do you evolve that? On the fintech piece, love it. I think the way, we can end up delighting clients by being pushed by innovativeness is essential. What I will say is this: I'd love to hear a lot more thinking about what? Financial data. We've digitized everything across financial services, or most everything. It is the most valuable thing you have right now as an individual. And it probably needs to be treated, regardless who's touching it, in a way that's more consistent with regard to protection, destruction, use, saleability. Back to the generation that's in this room, you trade your privacy for delight. That's what you're doing. You've got to make sure you understand the value of it and what you've traded. And we need to have collectively more conversations about that, because we don't want any real nasty surprises. I almost think of it, I think of it in my own head. I think we need some sort of HIPAA for financial data, right? No matter who touches it, you should have a level of expectation of how they're going to play with it. Whether it's Google or JP Morgan or BlackRock, it doesn't matter. Something to think about.
HIPAA for financial services.
I love it.
Do you like it?
Absolutely.
That's my new idea.
Great idea.
We could go on, for another couple of hours here, because it's
They will
pretty
thank us
clear.
not to.
And we, right. We haven't even touched on a bunch of things, but which I won't even mention. But I think you can see why it's so great having Sandy and Barbara come here. So please join me in thanking them for a wonderful session. And in coming days, we expect to post a video of this session on the Center's website. We also hope to see you all again on November 7th. We'll have our second fireside chat of the year with Jamie Farese, President of Citicorp Global Markets.
Great. Thank you.
Thank you very much. You're awesome.